What's going on, everybody? This is Cole back with another video, Free Trading Academy. We are learning how to make $1,000 a day in the Forex market. Today, we are talking entries and stop losses. So, the good stuff, the meat of this course, we're getting into it. How exactly do we put everything together that we've learned thus far with support and resistance, supply and demand, turning points, where the buyers and sellers are on this chart, and we actually take some entries. So I'm going to take it from the top. As we saw in the very first video, the best thing to do is to get your line chart out and to start marking the major turning points on your chart. I, for one, like to start with the 4 hour chart. I just think that's the best picture of the market. If you are a position trader or you like to hold trades, I would say longer than 3 days. Daily chart is a good place to start. The good thing about this strategy, supply and demand, breakout trading, is it's applicable on any time frame. If you're a scalper, you could work through this course and you could apply this strategy on the 15-minute time frame, 5 minute. The market repeats itself over and over again, regardless of what time frame you're working from. So I'm on 4 hour. We have the line chart up. I already have it partially marked off in the interest of time. But as you can see from this top line right here, this is a major institutional level. You saw huge selling pressure first go around, huge selling pressure on the second go around, and it's taken the market all the way down here. You're looking at about a 300 pip decline. So there's definitely big time selling pressure here. There's big time buying power, which is coincidentally kind of in the middle of this range. Took price shot up here. It shot up once more in this area as well. So we like this. We want to get that marked off. And then, of course, we have the very bottom of the range, which I always like to mark off as well, just so I can have an idea of where we're working with here. So we're going to switch over to the candlestick chart just to make sure everything lines up. Everything looks good and pretty. Next, we're getting out our rectangle, and we're just going to highlight these zones. Like I said earlier, price doesn't always respect a single line. So as you saw here, this line is at 153.28. Okay, price did temporarily break through. So if you're trading on the smaller time frames, that could be misleading. You may think price is breaking up to the upside. The candle closes lower and it heads off in the opposite direction. So that's why we do zones. All right, it just gives us a little bit more room to work with. All right, get that going here, cover that wick. Okay. Every time you're on a new chart, this is what you should be doing. Every time, even if you are a trader who only trades, which this is what I recommend if you're just starting off. If you're only trading 2 or 3 pairs, which is, like I said, what you should be doing, you should still be doing this every other day. All right, because we want to trade from fresh supply zones and fresh demand zones, and those are created every day in the market. All right, so we're talking entries here. We're talking entries. Okay, so assuming we don't know this has happened yet. All right, we have this marked off. This is a fresh demand zone. Price grinded down. It was shot right back up. So like we saw from our last couple of videos, we're now looking for buying opportunities when price gets back to this zone. Okay, it's a fresh demand zone. Chances are high that when price retraces back into that area, we're going to get another spike to the upside. Okay, so this is exactly what happens. So price grinds down, it takes off back up. Okay, but let's look at the particulars of what's going on here. Okay, so the ideal entry is right here. If you're watching this bar by bar, the ideal entry is right after this candle. Let me get this out the way, scooch this over. All right, this rejection candle right here means that the seller exhaustion has reached its fever pitch, and we are now looking to shoot up to the upside. Okay, you could take it right here if you're more of an aggressive trader. In my opinion, I don't like this trade as much just because this is following two pretty solid bearish candles right here. All right, so if you had any news that was bad for the pound, then this easily could have broke through and continued to the downside. Okay, so it's always best to look for rejection, exhaustion. That is this doji type candle, pin bar, whatever you want to call it. A nice long wick indicating that the sellers tried to break through this area and they were rejected. Okay, so obviously price didn't immediately take off, but if you were to get in the zone here, say at 151.54, you could take it up for an easy, at least, I mean, if you're trading a standard lot, you can make an easy 220 pips. I mean, the entire move started from here all the way up here, so that's about a 55 pip gain right there. Okay, so that's one entry. Things to look out for. Okay, things to look out for are fake outs. Okay, fake outs. This is a very strong and convincing fake out right here. Okay, so what this is you have a grab. It's called a liquidity grab. All right, so big money is trying to push price down as far as they can to grab up as many buy orders as they can, and then price reverses in the opposite direction. Okay, so that's why it's very important to wait for confirmation, to wait for the retest. Okay, so even if you saw this move right here and you said, hey, it broke according to our rules, it broke the zone. Okay, this still is not a valid entry. Okay, because it had a retest. The following candle should be a bearish engulfing, which would indicate that the downtrend is continuing. Okay, the following candle after the retest candle is a bullish engulfing. So that means that we're looking at a fake out. That means that we're now looking for buy opportunities to the upside. Okay. Keep in mind the entire context of what we're looking at here as well. Okay. This is the first time price has retested this zone since it originally broke out. Okay. Which means the chances are high that eventually price will continue back to the upside. Okay. So keep that in mind. Whenever price comes back to the zone for the first time, chances are very high, unless there's strong fundamental pressure against the currency, that it will reverse and go back in the opposite direction. Okay. So that's how you would trade that scenario right there. All right, let's take a look and see what happens the third time, price comes back. So my personal rule of thumb is zones, supply and demand gets weaker over time. Okay, I like the second bounce. I don't like the third bounce. Okay, so let's take a look at the context of what's going on here. So by the time price gets back down to this area, we have now a double top on the 4 hour. Okay, we already saw from our line chart that this is an area of heavy seller pressure. So we know that we are in a clear downtrend. All right. If you're risky, you could take this counter trend trade right here. I would not do that because, like I said, we're in a double top. Price is coming down. This is now the third test of this zone. So I'm honestly waiting for this to break to the downside, retest, and we're riding it down. Okay, which is exactly what happened. So let's zoom into the 1 hour chart and we'll see how this plays out. Okay, so like I said, here's the third time price is coming back. Okay, so this zone is barely holding up. You could have gotten in for a counter trend trade. It wouldn't have been terribly risky, just because you could have put in your stop. Could have put your stop right here. All right. Could have got in here. All right. So you would have had a bit of drawdown. Say you would have got in at 151.47. Price would have drawn down to 151.26. So you would have been about, 20, 22 pip stop. drawdown. Okay, so it's a pretty good stop. But I mean, look what your reward is. So even if you get in at the bottom of the zone, um, the highest price ever gets is, I mean, about 20 pips. So I mean, it's pretty much 1 to 1. To me, I don't like that trade. That's pretty risky, especially knowing that we're in a clear downtrend. Okay, so if you're a counter trend trader, if you like a little bit more risk, you could have taken that. But for me personally, I would not. So what I'm looking for is a clear break, okay, which is what we get right here with this bearish engulfing. So we have high momentum coming out of the zone. All right, we have two retest candles, okay, and then we don't have a nice engulfing candle here. I don't love this candle, but we have a real nice one here. All right, so at the close of this candle, if you're trading on the 1 hour chart, then this is your entry. Okay, mark this up. This is your entry. Now this is conservative. Okay, this is conservative. There are times when I've taken trades on, you see the momentum coming out, just from the entire context, like we saw earlier, we got a double top up here, lots of rejection. Okay, you see all these wicks, price fails to break through. We're heading down this way for the third time. So for me, I probably would have just said, hey, I have a good feeling price is going to break through. So I'm going to take a sell as price is coming out of this zone. That's risky, a little bit more risky. I wouldn't recommend that for new traders. That's what confluence trading is all about, though. You have to put all the pieces together. So let's go back to our example here. Okay, you wait for a good bearish engulfing continuation to the downside. You place your stop in the zone, or if you want a little bit of a wider stop, you could place it outside of the zone. Okay, and you just write it down. You write it down. All right, let's take a look and see what the 30-minute looks like. Good thing about trading for multiple time frames is when you zoom in, you could get a better, clear picture of what price action is doing in a zone, which will give you the best possible price. Okay. So on the 30-minute, you could have got in a little bit earlier after this candle right here. Okay, and you probably could have put your stop in the same spot. All right. So that's how you'd want to trade that. You wait for a clear breakout, you wait for a retest, and you write it down. All right. So even if you would have missed this entry, which if you did, then that's unfortunate. But if you got in here, I mean, you're coming down. I mean, that's like a 60 pip move. That's nice. I mean, imagine trading a standard lot. That's close to $600. Two standard lots, that's 1,200. That's how you make $1,000 a day trading this. This is just one currency pair, too, guys. We're not even talking about indices. So say you missed this entry. Okay, price comes all the way back. It's going to come back for the retest. Here you have just a very nice engulfing candle. Boom. There it is. You'll have a little bit of drawdown, okay, but you know that this is a continuation pattern. And look, price just drops. I mean, here's another 100 plus pips, okay, in a matter of 24 hours. So it's like I said, like I've been saying through this whole course, guys, it's that easy. It really is that easy. It's about patience. It's about understanding the complete market, and of course, trading with the trend. So this whole move here is a downtrend. All right. If you're a scalper, you could have been taking sells all while price is falling, marking up your chart on the hour, 30-minute with your supply and demand, waiting for levels to break and retest, and just taking this all the way down. We'll do a video later on in the course for the scalpers, what that looks like on the small time frames. Okay. But just a few things to keep in mind, guys. You want a clear rejection in the zone. Okay, so like I said earlier, you're looking for a wick. You're looking for something like a doji, hammer, something that indicates a reversal pattern is coming. You want a clear retest in the zone. Okay, do not enter the zone itself. It could be a fake out. All right. So like we saw earlier, price faked itself out. It grabbed some orders and it just shot back up. Okay, so be patient. With this strategy, you could use a really good risk to reward ratio. All right. So imagine if you say got in on a sell up here. All right. So you got in on a sell, your stop is maybe 20 pips into the zone, and you're riding it all the way down to the next target. I mean, that risk to reward is insane. Okay. So if you're patient, you wait for price action in the zone, then that could create some really good RR opportunities for you. Okay. Then also just don't trade, do not trade during the news unless you're a position trader where you're holding your trades for weeks, maybe even months, and news, here and there doesn't really affect your position because you've been holding it for so long. Stay away from news, red folder news. Let me type in a website that most traders use pretty frequently. I use forexfactory.com. Is a great site, investing.com, and also dailyfx.com. Okay, either three of those sites are really great to use to look for red folder events. If you don't know what that is, red folder is anything related to GDP, interest rate hikes, CPI, consumer confidence, just all those things that indicate either a strong or weak economy. That really moves currency pairs. But anytime, especially if you have central bank announcements, you do not want to be trading during those times. Okay. You'll probably get whipsawed and it'll just not be fun. All right. So stay off the news. Stay off the news. Okay. So just to recap, guys. All right. You start off on the line chart, mark off the major areas. Okay. Go over to your candlestick chart, get your rectangle tool out, highlight the zones. Okay. And then just wait for price to come to you. That's it. It's a waiting game. Wait for price to come to you. Let it do all the work and you make a smart decision and enjoy your profits. Okay. Thanks for tuning in. Stay locked in for the next video, guys. All right. Peace.